Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I'm here with your Cabot Weekly Review. I'm recording this on Friday, August 19th, just before 12 o'clock Eastern. As you can see here, the S&P 500 index is down around 1.4% today. Big picture debate right now, if you've read the papers, if you've been paying any attention, it's really about, are we in a new bull market or is this just a bear market rally? As you can see, the S&P 500 here is 12% off of its highs. It came up 16% or so off the June lows, and it came up right against this 200-day moving average line earlier in the week and has come back down since. So market technicians, technical analysts might say that a break above this 200-day moving average line is needed to confirm a new bull market, whereas failure to break out might signal lower prices ahead, potentially back down to new lows, which seems unlikely at the moment, but of course anything can happen. But we are in this sort of bad to better type economic data environment where with the June CPI, the inflation numbers coming in a little bit better than expected, oil prices coming down, prices at the pump down from their highs, things are feeling a little bit less dire than they were in July. In terms of small caps, obviously sort of my favorite asset class, the S&P 600 index here came up and it did just poke its head above the 200-day moving average line. Of course, it's down today with the broad market. Kind of interesting, small caps trade at a discount to large caps, so the forward PE for small caps is around 12.7, where it's just under 18 for large caps. So a pretty significant discount there, which when we factor in that there might be a decent amount of business coming back into the United States, trying to flee, some of the geopolitical tensions and also, work around some of the supply chain issues that really popped up over the last 2 or 3 years. Small caps look pretty compelling over the next couple of years from my perspective. Of course, a lot of it's going to come down in the near term to the economic data. So on that front, next week on Tuesday, we're going to get the second reading of the Q2 GDP estimate. That's going to be important for the market. And then as we get into September, on the 13th, we'll get the August CPI data. Of course, later in the month, the Fed comes back to the table on the 21st. And this is one of those battleground areas for the bulls and the bears. Those leaning more bullish think that the Fed's going to hike maybe 50, 75 basis points in September, and then we'll pause after that. Whereas those leaning more in the bearish camp think that the hikes are going to continue after September. In terms of where the market expectations currently stand right now, this morning I took a look. It looks like for September, 55% chance of a 50 basis point hike and a 45% chance of a 75 basis point hike. So pretty evenly split right there. Of course, we'll just have to wait and see. Again, big picture, this sort of bad to better thesis appears to be intact. September is a pretty difficult month for stocks historically. So given that, the stocks that I want to talk about today, a little bit more on the defensive side of the spectrum, talking about payments, processors, and some fintech names. Some of these names are defensive. I also have some more aggressive names thrown in for you. So we'll get to that in just a second. As always, these are not official recommendations. They're names that I'm noticing, things that I'm watching. It's helpful for me to focus in on one area of the market rather than kind of go all over the place. Obviously, do your own research if you intend to buy any of these stocks. But last thing today, big picture, just take a look at what the 10-year is doing. So largely responsible for why the market is down today. About a 4% jump in the 10-year yield today to almost 3%, so 2.996% right now. All right, let's move on to individual names. So everybody knows this one, large mega cap. MasterCard and Visa are both looking relatively stable. Of course, these stocks aren't going to go crazy to the upside, but I'm highlighting them because they are sort of bellwethers for the payments and processor space. In the last quarter, the U.S. payment volumes looked pretty good and international travel picked up. So they both have diverse businesses they should be able to handle a modest recession without too much trouble. So if you're looking for something that's quite on the defensive end, Visa and MasterCard tend to fit the bill. We should have a chart for Visa coming up here. Okay, yeah, it doesn't look that much different. Also on the sort of on the defensive end of the spectrum, FISV, ticker symbol FISV, another defensive fintech payments company. So they had a beat and raise second quarter, a little bit soft on the free cash flow line, but the market liked the result. And the stock is, it's been having a pretty good stretch of a few weeks here. If we go into another name, it's not on my list, so let me just type it in here. That's not it. Trying to get global payments. GPN. So another payment processor, again, slightly defensive, just came above its 200-day moving average line. So Global Payments just announced the acquisition of Evo Payments earlier this month. Probably going to be more M&A and divestments over the coming years as they kind of rejigger the business, but kind of jumped onto my radar because of that acquisition of Evo, a smaller player, and because there is typically a lot of M&A in the payments and processor space. This one was of interest. So a few more aggressive names. D-Local, ticker symbol DLO. I know it's not the best looking chart. So they have not reported yet. Most companies have already reported. They will put out their numbers on August 22nd. I believe that is next Monday. So DLO, I've talked about it a little bit before, just over 8 billion market cap company. So they are an emerging market focused payment provider, but they have big clients, Amazon, Google. So interesting things. Of course, earnings are likely to move the stock early next week. Another smaller, more specialized player is Flywire, ticker symbol FLYW. Market cap here is just under 2.7 billion. So this is a company that has a mix of a payments platform and then also software, and they target markets where electronic payments have been pretty slow to be adopted historically. So we're talking like education, travel, healthcare, getting more into business to business. But they had a pretty decent second quarter. Stock had been on a nice uptrend coming off of the June lows. We'll see about getting through the 200-day moving average line. The report was well liked by analysts. But again, in this environment, I'm trying to find stocks that have some upside, have some growth, but are still a little bit defensive. Nobody's going to say that a small cap company with a market cap under 3 billion is truly defensive, but given the context within which I'm trying to talk today about these names, I think Flywire is a pretty interesting name that skews defensive, within the scope of what we're talking about here. Another company here is TOST. Probably heard about this one when it came public last year. Came public at 40 and popped 56% the next day, and definitely caught the tail end of the bull market, but then things kind of fell apart. But their report last week was really the best report that they've had since they came public, where things kind of seemed to be making sense within the business. They offer a restaurant management platform, a couple of different things going on there. Of course, they have the payments, but they also have some fintech to kind of help manage the business, and also some stuff to help manage people. Stock had a nice reaction here after earnings. Was up 8% that day. Of course, after such a big decline, nothing really looks all that great. But if you can kind of focus on the last couple of months, the stock has been stable. And I was watching this one because that report wanted to see if TOST could hold on to some of those gains and get a little bit of follow through. That hasn't happened over the last 3 days. Of course, the broad market has been down, but based on the reaction to the earnings and the numbers, I thought it was worthy of putting on my watch list. So there it is. That's TOST. And then last but not least, we have PAYA Holdings, ticker symbol here is PAYA, and it's just a sub 1 billion market cap company. They offer integrated payments and other commerce solutions. This used to be Sage Payment Solutions. I think Sage was acquired in like 2017. PAYA was relaunched with the brand, came public in 2020. It has made a whole bunch of acquisitions since. M&A is definitely part of the growth story here. And again, if you look at this chart, we're trying to kind of find growth, but moderate growth with a little bit of downside protection in stable businesses. And I think PAYA offers that. Of course, obviously do your own research. If you read through their 10K and 10Q, you'll probably get the same impression. But stock had a decent reaction to earnings a couple weeks ago, and more or less this trend line here above the 50-day moving average line is intact. It is above the 200-day as well, but with this upsloping 50-day so far holding up, I think PAYA is looking pretty interesting. All right, guys, that's it for me. We will be back next week. Mike Santello will be back. Hope you have a nice weekend, and we'll talk to you soon. Take care.